The investment committee is looking to answer your questions. First up, one for Joe. Tyler in New Jersey writes, I bought Teradyne a while back after you recommended it on the show. I saw you recently sold it. What do you suggest I do with it now? What do you tell him, Joe?
Well, Tyler, it's very difficult to give a suggestion. I don't have an understanding of how much in your portfolio you're holding of Teradyne, but let's make an assumption that it is less than 2.5%. At that level, I would hold it here. I would wait to hear from management on the upcoming earnings, which is the end of April, where they stand on the auto chip shortage, and in addition to that, where they stand with the significant revenue exposure they have to Apple, which is recorded nearly 25%. So I would take a wait-and-see approach on getting out of the stock or even adding more until I hear from the company on earnings.
Above 2.5%, you recommend selling down to a 2.5% position?
Above 2.5%, I absolutely would be putting a stop in here as the stock has broken down significantly. I've sold out of it. The 200-day moving average sits at $100. So above 2.5%, yes, I would be looking to put a stop in to make sure you get that allocation and waiting below 2.5%. Got
it. All right. Next one's for Weiss. Jamal in New Orleans asks, Steve, what are you doing with Jumia now?
So I've recently bought more. Stock's down from 66 to well, it got down to the 30s where they priced their secondary. Look, it's very unusual to be able to buy a company with this kind of growth, essentially a mini Amazon, where there is no Amazon, with 1.2 billion people as their market, online penetration so low, and eventually this company could break into 3. Jumia Pay is growing like a weed. They're digital. They've got the only logistics company, which is 300 partnerships. So basically, it is a low CapEx company with super high growth, and they'll be profitable long before any other online seller you've ever seen reach profitability.
All right. Thanks for that, Steve.